Welcome everybody, delighted to be back here at Rollins College campus again and learn about all the sustainability education, the experience, and the student teams that are competing for prizes with their social enterprise teams. So what I want to talk about in our time together is how you can do good and make money at the same time, and cover how you can do that and how you might be able to do that in your own business, in your own ventures, and in your own portfolio. So I'm Paul Herman from HIP Investor. HIP stands for Human Impact and Profit. And we're essentially in the investment ratings and investment management business. So we rate more than 75,000 investments, stocks, bonds, funds, on how well they build a better world or avoid a worse world, and how that can connect to future risk and return. And so you can do this as an entrepreneur and a CEO in your own ventures. You can do this in your own portfolio. You can even do this in your 401k. And for some colleges, they're doing it in their endowment. So we'll cover all of that this evening, and happy to answer any questions along the way, or after the fact, feel free to be in contact. So the HIP Investor book was published in 2010 by Wiley, so it's a how-to guide of how to do this. If you have additional questions, feel free to take a look at that. It's on textbook, ebook, and audiobook. And when Dr. Mark Sardi teaches finance here, he uses the HIP book to train the next generation of finance experts. So our work is really working with investors, working with family offices, working with foundations, to mobilize their money to focus on impact, and that impact actually can generate, has the ability to generate a higher profit at lower risk. You may have seen us in the New York Times last weekend in mid-March 2018, talking about how ESG, environmental social governance, how you can invest with your conscience, and as the New York Times says, and make money too. So everything we're going to talk about tonight is related to investing, so you'll learn some ideas from this. Remember, this isn't personal investment advice, and past results are not indicative of future returns. But we're going to talk about some leading indicators about how you might be able to make your portfolio stronger and more resilient, and those lessons that you can take to your businesses and apply, whether you're big or small, for profit or non-profit. So what is investing about? Investing is about the future risk and future upside. But today, on our accounting statements and financial statements, those have been built for a century or 2 centuries ago. So what we're going to talk about are things that are invisible on the financial statements and might be invisible in your own business, and that you may want to pay more attention to, and that if you do, you can have more upside and lower future risk. So a quick overview of the past couple decades. If you remember back in the 1970s and 1980s, the US economy was made up of car manufacturers and exporting white goods and appliances like refrigerators and stoves and the like. And over time, some of those operations have moved overseas, and other businesses have grown up in technology and healthcare that are driven more by people and intellectual property than they are by physical assets. So today, in our era, more than 84% of stock market value is not on the balance sheet. It's not a hard asset like cash or inventory or buildings. It's actually people and innovation. And so that's reflected in the stock market value of the S&P 500, and 84% of that is driven by things that you don't normally track in your managerial accounting. So what are strategies that give you insight as how to create value and serve customers? And what are smarter ways to build profit? Well, first, we may all know, and we may even do this ourselves as CEOs, that say people are our most important asset. But there's a problem. People are not an asset on the balance sheet. People are actually an expense on the income statement. And so that incentive to cut expenses or cut people is at odds with valuing people as an asset. Now, hopefully we all agree that we want to appreciate as assets, as people, not depreciate as people. And so there's a gap in the accounting statements today to put people on the asset, people as an asset on the balance sheet. So that's something to think about tonight after you leave is, How could you improve your financial statements to capture all the ways to create value in your business? Of course, we need to use natural resources more efficiently. Water is underpriced or free in most places around, so we use more water than we might need. And eventually that may become a risk to charge more for water. Our management and our company hopefully is gender balanced and ethnic balanced, as well as balanced for our exposure to international markets and to different age groups. But do our executive teams and our boards reflect that? In the best companies, they actually do. So what the framework that we bring to you is we have a way to make this 84% that's knowable yet ignored more visible. And things that are not on the financial statements like customer satisfaction and employee engagement and employee retention actually drive revenue higher. When you make employees happy, they generally take care of your customers. Those customers come back. They create referrals and recurring revenue. And when you don't make your employees happy and they leave, then you need to find new employees. You need to recruit them and train them and get them to work together again. So just like when you bust up a championship team at the end of a season, it's hard for that team to repeat. Similarly, in organizations and business, as well as nonprofits. So what we do at HIP is essentially quantify all these factors, these customer, employee, environmental, and societal factors, and we map them to the financial statements, to higher revenue, like Unilever does in selling organic, sustainable food. Those are double-digit revenue growth markets. In expenses, now you might say, oh, shouldn't I cut expenses and cut people? Well, what we'll see this evening is when you invest in people, they have a potential to give you a higher return than when you invest in them. So a higher return on investment. So the professors at Harvard have actually analyzed all the factors in this 84%. And what they found is this, that companies who focus on people, focus on natural resource efficiency and planet, and focus on treating society right so that you're not sued from treating people wrong, generally outperform those who don't by anywhere from 25 to 40% premium. This is across multiple business cycles, and it's from Harvard, so it must be true. Harvard did an update to that in 2016 to show that when you focus on the most important material factors to your business, that in a service business if you focus on people, in a materials business if you focus on natural resources, in a trust-based business you don't get sued, that those companies as a portfolio could outperform by 6% per year. So in finance, finance markets are supposed to be efficient, but there are inefficiencies in investing. And so when you can focus on companies that do good, you can frequently make money. So let's take this down to like invention, like who invents products? People invent products. And when you invent a product, many companies patent them. So a few years back in 2006, 2007, a company named Ocean Tomo actually counted up patents by company and rated the quality of their patents. And what they found was building a portfolio out of the companies with the highest quality patents outperformed the market. In fact, it extraordinarily outperformed the market. Unfortunately, this investment fund did not survive because they did not pay enough commissions to the financial industry to get it in front of people. So this strong strategy built on innovation, a core value of all of us entrepreneurs, could not survive because it did not gather enough assets. Now, we all might know this Nobel Prize winner, Milton Friedman. He used to be at the University of Chicago. And we may be familiar with this quote that the one and only social responsibility of business is to increase its profits. Now, the interesting thing about this, which has become sort of dogma in education and in finance, is that just 14 years earlier, before his Nobel Prize, he said that the total wealth of organizations includes the productive capacity of people. So even then, and a Harvard Business Review article came out in the 1960s to say, put people on your balance sheet as an asset. So we know these answers. We already know these answers. They're intuitive. My mom would say, yeah, of course that's intuitive. So how do we get closer to operating the world like your mom would? So one way to do that is by studying the 100 best companies to work for. So this comes out annually in Fortune magazines, put together by the Great Place to Work organization in San Francisco. And it's a bottom-up survey across thousands of employees. And the employees vote on how well their employer treats them. So it's truly a bottom-up survey. And if anyone's looking for a job, these companies have more than 100,000 job openings. And they're attracting the best talent, and they're growing their companies. So this guy, Alex Edmonds, he's a professor was a professor at my alma mater, the Wharton School of University of Pennsylvania, where I studied entrepreneurship, like here at Rollins, and I studied finance and blended those together. And I blended in some political science and some psychology because changing the world is about human nature, not just technical solutions. So Alex Edmonds said, hey, let's look at these great places to work over time, and let's ask this question. Does the stock market reward companies, the best companies to work for? And do they outperform or underperform? So think about what your answer is. Do you think that the best companies to work for do better or do worse by profit or shareholder value? And the answer is this, that investing in the 100 best companies to work for over the period 1998 to 2016 nearly doubled the market on a year-over-year basis. Now these 100 actually are less than 100. 10 of those organizations are nonprofits, usually healthcare and hospitals. One of them frequently is Teach for America. Now of those remaining 90, half are private and half are public. So of those public companies, that's what this portfolio reflects. The private companies, like you may own in your own business, can achieve a similar type benefit. Now, the Great Place to Work certifies workplaces, so if you're interested in how this might apply to your own workplace, you can take their survey, and if the results come back positively, you can be certified Great Workplace. So here's another example of certified Great Workplaces outperforming. Now there's a mutual fund company called Parnassus. It's based in San Francisco, which is where I live as well. And Parnassus originally had something called the Parnassus Workplace Fund. Now this was a more active fund, so out of those 45 companies every year, they would select a subset to invest in. But over time, what they've been able to do from 2006 to today in mid-March is outperform the S&P. You can see the differences over time, that on average, it's up more than it's down, and that it outperforms the S&P. Now remember, past performance is not indicative of future results, but this is a way to reward, to potentially consider for your portfolio, to reward companies that are the best places to work for, and benefit from what we talked about before of investing in appreciating assets like employees. Now at HIP, we have a similar strategy like that, where we actually apply the HIP rating. So we not only take the base of the Great Places to Work companies, we add in additional factors, environmental factors, trust factors. And so over the nearly 5 years that it's been underway, the total portfolio has been up 97%. On a net basis, because we had some early startup fees, that nets out to about 86. And that beats the benchmark of 82% over that time period. Now last year we had a great year. It was 34% return versus the benchmark of 21. Can't guarantee that'll happen again, but it shows you the strength of investing in companies with good fundamentals that are invisible on the balance sheet that you, as high-growth entrepreneurs, may be building already. Now, this is one of my favorite charts because a lot of people get surprised at it. So, Credit Suisse is a financial firm. They serve they analyzed several thousand companies around the world, and what they found was this: that more than 800 public companies, large public companies, had no women on the board. Now, we live in a world of 50% men, 50% women. Many of those companies have 30, 40, 50, even 70% women. Those companies may have customers ranging from 30 to 80% of their revenue, yet there are no women on the board. So you can see that the financial performance over a decade is about 5% over that time frame, a cumulative of 5%, because it included the global financial crisis. Now, the other 2,000 plus companies had 1 or more women on their board. Some had 2, some had 3, some had 4, and that group returned 40%. And that is because they embed gender diversity, and in many cases ethnic diversity, international diversity, since these firms have large proportions of international revenue. But not so much age diversity. There's very few boards with people under 30 on them, even if they're selling to teenagers. So there's fundamentals at work here that are showing up in financials, and I'll share one more example with you, and this is of CEOs and what CEOs of public companies make relative to the average employee. And there's a new statistic that you'll see now that companies are publishing. What does the average CEO get, what does the CEO get paid relative to the average worker? You'll see some of those numbers come out that range anywhere from 300 to 900 to over 1,000. So what we found at Investor over the past 12 years is, this is one of our top 5 factors. If the CEO is being overpaid, it's demoralizing to employees. The capital that's going to the CEO is dislodging capital that might go into innovation or training. And essentially the CEO gets sort of a royalty complex, a Roman emperor complex, and they decide that anything they decide is a good idea. And that breaks down in terms of a collaborative environment with the wisdom of the crowd. So we can show here, and this is with a nonprofit we partner with called As You Sow. For the past 4 years, we've analyzed overpaid CEOs, like we've built into our methodology the past 12 years. And what you can see here is usually CEOs claim that they're getting paid for performance. And what you see is in the 3 years previous to getting overpaid, that there was essentially equal performance. And then in the 3 years since, they destroyed shareholder value. They lagged the market. So this is not only unfair, it's a silly way to invest. So as an investor, you may want to consider excluding, divesting, underweighting, or even shorting these most overpaid CEOs. And if you really want to concentrate it, you can look at the top 10. And in this case, on this chart, you can see that the top 10 did not outperform, and in the subsequent 3 years, actually destroyed shareholder value by more than 15 percentage points. So you can wrap all this together in your own way of thinking about your business, the world, and your portfolio. So HIP produces a 0 to 100 ranking where 100 is closer to heaven, or utopia, and 0 is closer to hell, or dystopia. And that if you think of this as a hurdle over 50, that anything over 50 can produce net positive benefit for society, for people, for planet, and for society. And that net 0 is actually extractive. And it seems to be a propagation of proof that large enterprises are extractive of society. They don't pay people a fair wage always. They're extractive of natural resources. They're not diverse and inclusive. And in some cases, they're not even transparent. You can't see inside. And so if you can't see inside something, you can't judge the risk. So what we find at HIP by rating the products and services of the company and doing a weighted average revenue blend, which you can do in your own companies. What are the benefits to your customers, to their health, to their wealth building, and income and assets, to the environment in terms of water and air and clean land, to the equal opportunity and progression of women and people of color and age, and to trust overall, which we find more and more frustration with large companies breaking the public trust. So we bring all that together, we collect all this open, available data from multiple sources, bring that together to build this 0 to 100 HIP rating. And what we find is this. In a universe of 7,000 companies, looking at the last 5 years of shareholder return, which we've looked at this for 3 years and for 10 years, and we review this every year, that in general, for a diversified portfolio, the higher sustainability, the higher impact, the more that you do good, then the higher the return. And that the less you do this, or the more less transparent you are, or the worse you treat people in the environment, as a aggregate, you make less money and you might even lose money. So there's examples, single examples in any case that may break this, but as a group, this holds. And now there's more than 2,000 academic studies that show this to be true. That if you do good, you won't necessarily make more money. Frequently, you might make more money. So the UN has a Human Development Index. It measures the health and education and well-being. This is a HIP version of the Human Development Index by country. And so you can see the red areas have some development needs for healthier people, for more opportunity, for less infant mortality. You can also do this for states. So you can take the census data and start to plot. Now some people might say this looks like a political map, but this is really a condition of the well-being of the people in these states. And you can break it down to a city and a school district. And you can rate a hospital on its health outcomes and patient satisfaction, and kindergarten to 12 school districts on their school performance and access to free lunches. And what we find there too is that the more you bring positive impact to the citizens, to the beneficiaries and the customers, that the more likely you are to be stronger and more resilient. And the more extractive you are, then the more you're creating disruption. And what we find over history is that societies and organizations that are extractive ultimately collapse. So I'm not interested in a collapsing society, I'm interested in improving society. And so the value and benefit of taking a look at the world in this way, of looking beyond just what the accountants or auditors say is valuable, but to the core value of people and planet and society that are drivers of value, that I've shown you financial evidence for, is that there's at least 3 benefits. 1, you can analyze more risks. You can identify surprises. 2, you can better understand what drives cash flow and return on investment, like investing in people and training them up so they can be the future leaders of your organization. And 3, you can construct higher impact portfolios, both in your own investments or your IRAs, but also in your 401ks. So what are the tangible things? I'll show you some examples about how you might do this in your own world. 1 is, how do you do that in your portfolio? 2 is, how might you do it in your business, including your 401k? And 3, how might you do it with your college or university that you're an alum of? So this is a view of a portfolio. We like to call this the bubble chart. It's a lot of planets. Some are Jupiter-sized, some are Mercury, some are asteroids flailing around. And the size of these bubbles is how much you have invested in stocks or bonds, or for some people in hedge funds or pipelines or oil and gas. And these all fit on a risk-return graph, because remember, to get higher return, you frequently need to take higher risk. So we've color-coded this by what the impact on society is, what the future risk is. To build up from the bottom up, what investments are being extractive of people that aren't paying them enough, that aren't training them, that are diverting money from R&D. And when you see something red on this, you probably want to look for a substitute. So we have a portal at Investor where you can research some of these ratings. There's a free trial for you to sign up. And what you'll find are examples like this, like Pepsi versus Coke. So some of us may be old enough to remember to take a blind taste test of Pepsi versus Coke and which tastes better. But for the younger people today, who decreasingly are drinking soda with high fructose corn syrup and choosing what's called Mexican Coke with real cane sugar when they drink that type of soda, what's important also is water usage. And so Coca-Cola, which is a 100% beverage company, uses a tremendous amount of water to collect the water that they put in the can or bottle, to process that, to produce the can or bottle or plastic, to process the sugar that goes into that. And so for every can of Coke that you might drink or people you know might drink, there's more than 2 units of water. So every time you're drinking 1 unit of Coke, you're drinking 2.5 units of water through the process. Pepsi is a half food, half beverage company. On a volume basis, they use less, but there's some additional efficiencies that Pepsi is getting relative to Coke, and so that may be an important reason to shift what products you buy, or if you buy them at all, and how you may, what you might choose as an investment. Now, one of the things that we do with companies is to help engage their employees. And one of the ways to engage their employees is employees want to know, am I investing in a world that I want to live in? Am I investing in a future world that I want to live in? So here is a detailed chart, color-coded chart. We like to call this air traffic control, which is, these are about 30 funds in a 401k plan. And what you see here, what lights up green, yellow, red, right in the middle, you can see a bunch of orange. Those are some traditional investment portfolios that are full of oil, gas, coal, and the industry associated with them. So to many young people today, protesting on campus, and for groups of students here at Rollins that have pushed the Rollins endowment to divest, this is important in your 401k as well. So employees want to know if they're improving the world through their actions. Now, when we put this in place with companies, it actually stimulates the employees to be even more engaged. They think of ideas to connect with customers, to add to their supplier criteria, and to win new business by showing larger companies that you're dealing with a sustainable company. And you can do this in your college endowment. And so this was recently covered in a college endowment magazine, Business Officer, which goes to presidents and trustees. And Becker College is based in the Northeast. It has a Muhammad Yunus Business Center. Muhammad Yunus is known for microfinance. And so he's helping universities teach social business around the world. We're grateful that Muhammad Yunus put us in his book and talking about what the future of finance could look like. And what we did with Becker College was say, you're putting in a Muhammad Yunus Social Business Center, your endowment should be sustainable too. And maybe this applies at Rollins. Maybe with all the sustainability education, you can vote with your dollars in your endowment. And what has happened in a very short period of time, and again, remember this can change over time, is we've been able to shift the endowment towards more sustainable investments and investment funds. For the time being, to increase return and reduce risk, and to drop the fees. And so by using separately managed accounts, which are customized portfolios, you can actually drop the fees, in this case, by 38%. So it could be better, potentially higher returns, lower risk, lower fees, and better for the world. So those are things you can do in your own portfolio. Those are lessons you can learn in your own business and apply in your own business to really focus on the talent in your organization, to unleash their engagement. And it's not like the 20th century where employees will stay for 10 or 20 or 40 years. If they're not happy, they'll move on. So if you want to attract the best talent, if you want to engage them, if you want to grow your business and benefit from the innovation of your employees, these are concepts and principles to consider applying into your own business, and maybe even putting people on the balance sheet as an asset. And then finally, with relationships with your college or alma mater, to help use that power of the market too, to drive financial and fund companies to be better. So I'll wrap it up right here. Hopefully this has been inspiring and educational. I've been inspired and educated by the students and faculty here the past few days, and look forward to continuing the ongoing relationship with Rollins to do more good, structure ventures that can make money at the same time, and bring together and build a better world. Feel free to contact me, Paul at Hip Investor, or follow us on Twitter or LinkedIn, and look forward to answering your questions about how you might do this in the world. Thanks. So first of all, to operate a business and innovate, you need the best talent. And the best talent these days, younger people, want to not just work 9 to 5 and volunteer afterward, they want to feel purpose at work. And if they do feel purpose at work, they'll work even harder. So there was so one is how to position your company as a leader that is doing good, that is solving a human problem or a social problem or environmental problem, or that may even address the coming risk of Miami being underwater in a few years, or the lack of power in Puerto Rico. So what are ways to do this? So one is to think about what products you're offering and what benefits they have today. And what net positive or net negative benefits they have to your health, to building people's wealth and financial independence, to the overall environment, what those impacts might be. So being able to communicate and tell a story of what you're already doing through an impact lens. And then you'll see that you may attract more or better talent in doing that. We're going to be really energized and productive. And don't think of work as a task, but think of it as a mission. So I'd say that's one. Take your existing products and services and put it through an impact lens. And an impact lens is something like the United Nations Sustainable Development Goals. And there's 17 of those. So you have a wide choice, and you can do one or more than one. And a company like SAP actually sees that its customers can address all 17. And through a software high-tech business, you might be able to do that as well. So that's one. Two is product and service opportunities are actually in solving these human, social, and environmental problems. Government funding is going down. Nonprofit funding is difficult to achieve. So if you can wrap a healthcare solution or energy efficiency solution through software and sensors, those are double-digit revenue growth businesses. So companies like Unilever are finding this and selling organic, sustainable food. These are double-digit revenue growth businesses. They're not clawing for single-digit growth and stealing market share. They're innovating. So that's a second that helps your top line. So focus on recruiting the best people and unleashing their purpose, and then the top line. Third is take a look at your financial statements, and you're going to see things historically as expenses. But flip it around and think of it as an investment. If I make an investment in this employee, if I make an investment in this piece of capital, what's the multiplier effect that I get from it? That's why high-tech businesses get high valuation. You can build intellectual property, and you can deploy it in multiple channels, on multiple devices. Netflix is able to grow its business around the world, and by essentially producing the same content and with little customization. So think about that, how expenses are really investments, including your staff. And then the fourth one is you may be making capital decisions. Where do I put my next group of profit? How do I reinvest capital in the business? And think about what the invisible costs are that you're not yet accounting for. And talk to your accountants about that. You know, there's probably some energized young accountants in your accounting firm that really are looking for a chance to show what the full systems cost and systems thinking are. And then finally, read history. And read history of Easter Island, which basically suffered from environmental degradation. Read the history of the Athens Empire and the Roman Empire that grew too big. We're at risk of some of those collapses. So in your own business, think about the system, what your role is in that system, and how you'll position your system, your products, your people, and how you think about the business in doing that. So it's easy to think of something new as a fad or that this may pass, but this continues to gain momentum. So I mentioned before in school, the sustainability program here at Rollins has become bigger, not smaller. The Muhammad Yunus Social Business Centers are on dozens of campuses, not single campuses. That students are starting social ventures. There's something known as the Global Social Venture Competition, where students are competing not in a traditional business line competition, but how to solve problems locally and globally. You have entrepreneurs like Elon Musk deploying renewable energy and batteries, not only in Australia, but negotiating to solve the problem in Puerto Rico. There's no lack of problems that we all complain about. The question is, how do we want to organize to solve them? So if you're willing and open-minded enough to think about what people remember you for. Will they remember you for being rich and having a nice car, or will they remember you for bringing healthcare to all parts of the community? Will they remember you for helping over flooding when there's intense weather? So there's something that you probably have in your youth that you said, when I grow up, I want to be known for this. And typically those problems are helping people, helping the environment. And you probably even have an easy answer today, which is you might be giving money to charity. So think about that charity as a business. What revenue model might work for that? We shouldn't be selling human rights, but there's healthcare approaches and microfinance approaches that have business models that are profitable. So Muhammad Yunus won a Nobel Prize for creating the conditions for peace. He also created an organization that is a profitable organization, a nonprofit bank that is very profitable. So there's the opportunity to do that in your business, to energize the teams that you have today, to unleash their potential, and to have your business last for decades, not years. So that would be my encouragement, is open up your mind, think about your charity and how that might fit a business, and think about what you want to be known for and how you can use the resources that you have to solve this. And the students at Rollins are anxious for those opportunities, so you have some place to recruit talent from. Sure. Yeah, so hopefully you're doing this already, but asking your employees what they want, what their vision is for the business, and listening for new ideas that might fit with the customers, especially if they're out with the customers. Listening to your salespeople, not only of what the next incremental product is, but what's the next transformational product. And to look for opportunities to, as the city of Orlando seeks to be more sustainable environmentally and to solve poverty and transportation issues, to find ways to link into that from a business perspective. So that would be one, just thinking creatively about where to go. Two is talent. Like, look where the high growth companies are today in the Inc. 500 or the Inc. Magazine 5000. Many of those are healthcare and financial services. Those are low capital businesses generally. And certainly Florida as a destination for retiring seniors. There's opportunities in things like memory care. So what are those future needs of retiring baby boomers that fit with your business? And what are the needs of millennials who are frequently financially strapped? How do you bridge that gap? You could also think about what benefits you could offer. So historically, after World War II, the veterans came and they got jobs. Today, students have student debt. So there are some companies pioneering retiring student debt over time that will pay for student debt, which could work out accounting-wise or tax-wise with your business from a benefits perspective. Some other things are the 401k. So because not only can you create a system where you can help people save for their future. When I worked in consulting, there's a very strong alumni network. So even people who left the consulting firm at McKinsey ended up doing business with McKinsey. So if you create these strong relationships today, even if people leave to move or start a family or change locations, they will look for ways to refer business back to you or do business back to you. So really think about cultivating people as an ecosystem, helping solve problems that make all of our lives better, and then think creatively about how to craft a business around that and to be regenerative and contribute back, to not be extractive to society. So to be a source of net good, not net negative. So I'd say those are some ideas that are tangible and real, that can bubble up from the people who work for you if you give them a chance to be empowered and to shine.